Hello everyone, and welcome to Business School 101. Have you ever wondered what businesses own and use to generate revenue? How do companies track their resources, and why does it matter in financial reporting? The answer lies in a fundamental accounting concept called assets. Assets are the backbone of any business. They represent everything a company owns that has value and can be used to generate income. But what exactly qualifies as an asset? How are assets classified? Why are they so important in financial accounting, and are there some real-world examples? In this video, I will discuss these questions with you. Section 1. Definition. In accounting, an asset is defined as a resource owned or controlled by a company that provides economic benefits in the future. Assets help businesses operate, grow, and generate profits. For example, a bakery's assets include its cash, the flour and ingredients it uses, the ovens and baking equipment, and even the building where it operates. All these assets contribute to producing and selling baked goods, which ultimately generates revenue. To qualify as an asset, a resource must meet three conditions. First, ownership or control. The business must have rights over the resource. Second, future economic benefit. The resource must help generate revenue or reduce costs. Third, measurable value. The asset's worth must be quantifiable in monetary terms. Assets are recorded on a company's balance sheet, and they play a crucial role in evaluating financial health. But not all assets are the same. Let's take a closer look at how they are classified. Section 2. Classifications. Assets can be categorized in several ways, but the most common classification is based on liquidity and lifespan. Type 1. Current assets. Current assets are highly liquid assets that are expected to be converted into cash, sold, or used up within 1 year. These assets are critical for a company's daily operations, ensuring the business has enough resources to cover short-term liabilities, expenses, and operational costs. Examples of current assets include the following. Number 1. Cash and cash equivalents. These are the most liquid assets, including physical cash, checking accounts, savings accounts, and short-term investments like treasury bills. These are immediately available for business expenses. Number 2. Accounts receivable, AR. These are money that customers owe the company for sales made on credit. Businesses expect to receive these payments within a short period, such as 30 to 90 days. Number 3. Inventory. It includes raw materials, work in progress, WIP, and finished goods that will be sold to customers. Number 4. Prepaid expenses. These are payments made in advance for services like rent, insurance, or subscriptions. Since these expenses provide future benefits within a year, they are considered assets until used. Type 2. Non-current assets. Non-current assets, also called long-term assets, are resources that a company expects to use for more than 1 year. These assets are not easily converted into cash and are essential for the company's long-term success. They are used in business operations to generate revenue over time rather than being sold for immediate cash. Examples of non-current assets include the following. Number 1. Property, plant, and equipment, PP&E. These include land, buildings, machinery, vehicles, and equipment used in production or operations. These assets depreciate over time, except for land, which typically appreciates in value. Number 2. Intangible assets. These include patents, trademarks, copyrights, and goodwill fall into this category. Unlike physical assets, these assets provide competitive advantages and brand value. Number 3. Long-term investments. These are investments in stocks, bonds, real estate, or ownership stakes in other companies that the business plans to hold for years. These assets may generate income through dividends, interest, or capital appreciation over time. Section 3. Self-test scenarios. Now, let's practice applying these asset criteria to different scenarios. I will present several situations, and for each one, I want you to determine whether it qualifies as an asset. If it is an asset, try to identify the appropriate account name and its dollar value. If it is not an asset, consider which criteria it fails to meet. Feel free to pause and think about each scenario before hearing the explanation. But if you prefer, you can simply listen through the answers. Let's get started. Scenario 1. Zenith Electronics sells $75,000 worth of equipment to a customer, who promises to pay within 45 days. Answer. This qualifies as an asset called accounts receivable. Explanation. A past transaction occurred. Zenith delivered equipment to the customer. In exchange, the company received a legal right to collect cash in the future. Since the payment will be made within 45 days, the benefit can be reasonably estimated at $75,000, the amount owed on the invoice. Scenario 2, Zenith Electronics signs a contract to supply $120,000 worth of microchips to Orion Technologies every month for the next year. Answer: this is not an asset. Explanation: no past transaction or exchange has occurred yet. The agreement is for future deliveries, but no goods, services, or cash have been exchanged. Because nothing has been transferred, no asset can be recognized. Some of you might wonder, both scenarios involve promises, so why is the first one an asset while the second is not? Great question. In question 1, the customer's promise to pay is backed by a completed transaction. Zenith Electronics has already delivered the equipment. In question 2, only a contract has been signed, no cash, goods, or services have changed hands. If Orion Technologies broke the contract, Zenith wouldn't automatically have a right to claim the $120,000. This distinction is crucial. Accounting only recognizes assets when they stem from completed exchanges, not just agreements for future transactions. Scenario 3, Stellar Manufacturing purchases $90,000 worth of aluminum sheets as raw materials, pays in cash upon delivery, and receives a 3% discount. Answer: this is an asset called inventory, valued at $87,300. Explanation: the aluminum sheets were acquired in a market transaction, which is a past exchange. Those aluminum sheets provide future economic benefits, as they will be used to manufacture finished products for sale. The asset is recorded at its actual cost, $87,300, after applying the 3% discount. Scenario 4, Apex Consulting pays $12 million upfront for 1 year of office rent. 1 month has already passed. Answer: this is an asset called prepaid rent, but its current value is $11 million. Explanation: the company paid in advance, securing future rights to use the office space. Since 1 month has already been used, the remaining 11 months still provide economic benefits. The value is adjusted to reflect only the unused portion. So $11 million is recorded as prepaid rent. Scenario 5, Apex Consulting purchases land for $200,000. The broker claims it's actually worth $275,000. Answer: this is an asset called land, valued at $200,000. Explanation: the land was acquired through a market transaction. The value of the asset is based on what was actually paid, not an estimated or speculative amount. The broker's opinion about the higher market value, $275,000, is not used because accounting relies on objective, verifiable numbers. Section 4, why are assets important? Assets play a critical role in companies' financial analysis, decision-making, and business strategy. They influence a company's liquidity, profitability, and solvency. Number 1. Liquidity. Liquidity refers to a company's ability to cover its short-term debts and expenses using its current assets. Companies need enough liquid assets, such as cash, accounts receivable, and short-term investments, to pay salaries, suppliers, and operating expenses. For example, a retail store with strong cash reserves and inventory turnover can easily pay its bills, while a store with slow-moving inventory and low cash reserves may struggle to stay afloat. Investors and creditors analyze a company's liquidity ratios, such as the current ratio and quick ratio, to determine its financial stability. Number 2. Profitability. Assets drive a company's revenue by enabling production, sales, and operations. Without assets like factories, equipment, technology, and intellectual property, businesses would struggle to generate income. For example, a hotel chain relies on its hotel buildings, rooms, and amenities to attract customers and generate revenue. Similarly, a manufacturing company depends on its factories, machinery, and inventory to produce and sell goods. Businesses with efficient asset management can maximize profitability by utilizing their assets effectively. Number 3. Solvency. Solvency refers to a company's ability to sustain operations and meet long-term financial commitments. Non-current assets like land, buildings, patents, and long-term investments provide a company with financial stability and future growth opportunities. For example, a real estate company with a portfolio of high-value properties can generate rental income and capital appreciation, ensuring long-term financial health. Investors and creditors examine a company's debt-to-equity ratio and asset turnover ratio to assess whether it has a strong asset base to support its financial obligations. Section 5, Conclusion. In summary, assets are everything a business owns that provides future economic benefits. They can be classified into several categories based on their nature and usage. Understanding assets is critical for financial reporting, business decision-making, and investment analysis. Whether you're managing a business, investing in stocks, or analyzing a company's financial health, knowing how assets function gives you a competitive edge in finance and accounting. That wraps up today's lesson on assets. If you found this video helpful, don't forget to like, subscribe, and leave your comments below. Thanks for watching, and I'll see you next time.